Wanted to take a look at economic data that we got on Friday. Of course, non-farm payrolls coming in a bit hot. As well, we've got inflation data points coming in Wednesday morning, and then the Federal Reserve Wednesday afternoon. Should be a huge week. We'll see what the Federal Reserve is thinking regarding future interest rate cuts, which I have been saying for over a year now. I don't see cuts at all in 2024, probably not until 2025. That's playing out as I've been calling that. From here, what can we expect going into Wednesday morning with inflation data? Thing is, payrolls, employment situation, and inflation are both lagging indicators, and they kind of go hand in hand. So the fact that we've seen a fairly strong employment number tells me we're probably going to continue to see strong price pressures. And the Federal Reserve was probably going to step forward and say, we don't have the confidence that 2% is going to be hitting anytime soon. From that, we're going to keep interest rates higher for longer. Some of the board members have mentioned that they think that the potential of interest rates moving higher is a possibility. I have been saying that since all the way back in September, October of last year. So we'll see. Let's jump in. I want to show you some charts, break down what I think is going to happen with SPX, the overall broad index, and of course, the Dow Jones and NASDAQ. Let's jump in, look at some charts. Here we're looking at two numbers, civilian labor force and those in the labor force that are employed. How are you in the civilian labor force? You either are working or you want to work. The green is showing us the overall civilian labor force that are employed. And if you look at these numbers, they just don't seem like it's hard to kind of explain this, because we saw a drop in the civilian labor force and we also saw a drop in the number of employed. Now, when we get a drop in civilian labor force, that basically says that certain people have been unemployed for so long that the Bureau of Labor Statistics doesn't consider them wanting a job, so they're removed from the pool. At the same time, there was a drop in employed civilian labor force. So when I looked at those numbers, I'm like, how does this add up? Non-farm payrolls, fairly frothy at 272. Now, this is pretty much sticking to a pattern. We've seen probably, I want to say like 225 to 250 is a range that we've been seeing month after month increases in overall non-farm payrolls. So if we saw such a big increase in non-farm payrolls, how is there a drop in the civilian labor force? It's been difficult for me. I keep looking at these numbers. I keep breaking everything down and asking the question. And it's just one of those things about these data points. You can't really look at them. There's a great saying in economics, one data point is not an economy. And when you break down, okay, who's the total civilian labor force, how many of them are employed, what's happening on a monthly change, this really encapsulates that concept of one data point is not an economy. So you have to look at the overall broader trends. The broader trends for the civilian labor force, the chart in the bottom corner there is, we've pretty much topped out where we are. And employed are also topping out, but we're still consistently adding jobs. The unemployed civilian labor force, this of course is mathematics. You've got the civilian labor force minus the employed gives you the unemployed. If you don't want a job, you're considered not in the civilian labor force and you're not working, you are not considered unemployed. You're just considered a stay-at-home girlfriend, whatever they want to be called today on TikTok. That's how that works. So you need to understand these three numbers. This is how it all breaks down. This gives us the unemployment rate. And this is just the unemployed divided over top of the civilian labor force. Of the individuals who are considered in civilian labor force and want to work or are working. And here, of course, is the unemployment rate that's going to go hand in hand with the unemployed numbers versus the civilian labor force. All right, headline CPI. This is something I wanted to talk about because we see this number on Wednesday morning prior to the Federal Reserve announcing their decision Wednesday afternoon. Wednesday afternoon, I think it's about 2 o'clock, 1400 New York time, where we get the decision 30 minutes later. There's a press conference with Jerome Powell, the Fed chairman. Headline CPI inflation, I expect, should maintain about the same pace, flatline, but elevated. The core rate has been moving lower and lower, but at a really sluggish pace. Consistently, the Federal Reserve has said we are not confident that we're going to get to the 2% level. So if on Wednesday morning we get inflation data, now one thing to point out, the CPI number, of course, is not what the Federal Reserve looks at. They look at the PCE price index, personal consumption expenditures deflator index, its technical name. That's what they watch. These two go hand in hand. There's some subtleties in between them. So we get the PCE price index the very last, I think it's the very last Friday of every month, working Friday of every month. And that gives us an idea as to what the Federal Reserve is looking at. CPI will give us a 2-week head start on what the PCE is going to look like. The PCE also, of course, brings in personal incomes, personal expenditures. Those three indicators for me are where everything starts. If we get more and more people added to the payroll, more and more people on aggregate within the economy have the ability to spend money. Expenditures drive revenues. They also drive more hiring. So, and it also, by extension, is price pressures. But there's a lag between the two. So while we're seeing CPI inflation data, the core rate coming in kind of slowly moving lower and lower, getting closer to that 2% rate, it's not enough. If you take a look at the month over month change, if you multiply that by 12, getting you an annual rate, non-compounded, it's well above. It's pushing somewhere between 3.75 and 4.25 annual rate, given the current month over month levels. We need to see a significant drop in core inflation for that to occur. I don't see that happening. Not this month, especially since we're seeing employment numbers popping higher. Core inflation versus personal consumption. The red line here, of course, is inflation, and then the green line is personal consumption. And income drives consumption, drives revenue, price pressures, employment. If you took this green line and you slid it over just a little bit, they line up perfectly. That sliding over is the delay, the lag in the indicator. And it's a good 3, 6, 9, 12 months. So after we see a constant sort of spurt in the economy, 3, 6, 9, 12 months later, you see price pressures, you see hiring. Inflation and employment go hand in hand. As the consumer spends more or less on an annualized basis, this pushes businesses to hire more to meet demand, or prices start to shift because demand can't be met. So that's how that works. So we're looking for a delay here, and the information we get on Wednesday is going to give us an idea as to where the Federal Reserve could be moving. Considering we just got that pop in non-farm payrolls, I think the Federal Reserve gets pretty strong in their verbiage, basically saying no confidence, we keep interest rates higher for longer. Raising interest rates is not off the table. We are data dependent is kind of the information we're probably going to be getting out of these guys. They're not really going to say yes or no that they're going to be raising interest rates. I think they're going to maintain a consistency that they will likely keep interest rates where they are for as long as they need to. And the fact is, at these levels, eventually the Federal Reserve will achieve its goal. But this is really going to tax what finite incomes actually already exist. People are going to not buy cars, not buy houses, simply because it's cost prohibitive, and that slows the economy down. At the same time, purchases on credit cards are already being taxed, and so individuals are slowing down. We're seeing that sign. Yet at the same time, we still see employment numbers moving higher and inflation not falling fast enough. Higher for longer? Absolutely. Indication as to when they cut? No time soon. On the news Friday, and this is the 4-hour bar chart for U.S. 10-year Treasury yields. The 10 years a pretty good sort of jump between the 2 and the 20 or 30, the longer dated Treasury yields. So I always defer to the 10-year. The 10-year is sort of your benchmark investment rate. This is where you compare everything to. And we saw a pretty decent pop higher. We had been trending much higher, pushing well above 4.5% all the way up to 4.6, call it 6.4%. Then things just slid all the way down. We're reversing. Come Wednesday morning, I'm going to be playing the market in such a way that I expect we could see a pretty decent sized move in interest rates. Most likely yield would go higher, surprise to the upside, but I'm going to play both because the Federal Reserve could, at the end of Wednesday, come out and say, but we believe we'll get there faster, and then all of a sudden interest rate yields push much lower. Now I've been buying TLT stock, of course the ETF versus longer dated 20 and 30 year Treasury prices, and that trade's been working out just great. I haven't been adding much to it, and I probably won't for some time. I expect a lot of movement to really occur after summertime. We're kind of in a lull right now. I see a lot of activity that's just sort of suppressed overall. So that's something I'm kind of looking at. Finally, here is a look at the this is SPY stock, 1 hour bar chart, and you can see pre-market, the big drop lower after non-farm payrolls, then the move higher. I expect we'll probably be sideways between today being Monday, Tuesday, and Wednesday. But come Thursday and Friday, things will get interesting. And I'll probably get pretty involved in some options trading with no idea what's going to happen Wednesday. So probably Tuesday afternoon, just before market close, I'll buy an at-the-money 1 DTE straddle, buying SPY stock, put and call at the money with the idea it's probably going to be a great ride on Wednesday. No idea if the market's going to go up or down. I expect with inflation data, the market will probably tank pretty hard if we get a consistently robust number. Employment tells me we will get consistent, robust number. Federal Reserve, by then I might actually already be out of my trade, but the Federal Reserve is very likely to give us a further indication that interest rates are going to remain higher for longer. Yields may pop up a little bit, but the eventuality of the yields will come down, and that's why I'm buying TLT stock the way I am. Regardless, this is how I'm trading my things. If you want to continue to be updated on this kind of content, breaking down the economy, how it affects the stock market, links like and follow down below. We'll see you in the next video.